Okay, let's have a look at where we are. And over the last week, some sanity seemed to return to the market. Powell made it very clear in his 2 days in Washington that there's probably, based on where they think the economy is going, 50 more basis points in rate hikes coming. He made that clear. And the market started paying attention to rates, started paying attention to the yield curve inversion. At one point, it was the 2s to 10s breached 100 basis point inversion. That became the talk of the day. And the economy. You had leading indicators last week, negative again. So we'll talk about that this week. Let's look at our rates, money market rates, all being well behaved, all respecting where the federal funds rate happens to be, anywhere from 5.17 to 5.25 up to the 1 year. And then you have your inversion in your capital market yields from the 2 to the 30. The 2 to the 10, negative 97 basis points, and it did breach 100 basis points last week before correcting on Friday to negative 97. 354 days now. And here we look at depth times duration. This is deep, and it's been a long time. Whenever you've had those two things come into play for the 2s to the 10s, that depth for that duration, a recession has always followed. Always. Not every inversion of the 2 to the 10 leads to a recession, but when you have this depth by duration, it always has. If we look at the 3 to the 10, every inversion of this has led to a recession. Well, now we've got a lot of depth. The low here was 189. We're 167, added 10 more basis points to the inversion. 241 days now, that's 8 months. So with this depth and duration, again, the 3 month to the 10 year, that inversion has always led to a recession. The deeper the inversion, the sooner the recession. It just accelerates the arrival of a recession, simply because it changes the flow of capital in an economy. The 3 month, 18 months from now minus a current 3 month is negative 145 versus 152 last week. Looking at the Fed balance sheet, it rolled off by $1 billion, but the SOMA decreased by almost 20 billion. So the Fed balance sheet on its own increased by 19 billion outside of the assets that were collected during quantitative easing. So the balance sheet is now under 7.6 trillion, 7.59 trillion versus 7.61. I don't know if we'll see a 6 handle on this by the end of the year. Now, there seems to be some confusion when we get to money market funds. There was some talk on Bloomberg on Friday that, hey, listen, this is the second week now we've seen outflows from money market funds. They must be going back into the equity market. And we have to be careful here because the Treasury is now issuing T-bills. If before I couldn't get T-bills, I had to get into the money market, into a money market mutual fund, especially a government money market mutual fund, because if they couldn't get T-bills, at least they had access to the reverse repo. Well, now that they're issuing T-bills, I can get them on my own. So we have to look at where they're coming out of the money market. So decreased by another 18.23 billion. Retail actually increased. 6.6 billion, increased in government by 2.82 and increased in prime by 4.19. Institutions decreased by 25 billion, but look what's going on here. This 24.89. Government down 25.16. Why? Because they can do it themselves. There's T-bills out there now. They can do it themselves. They don't need the money market funds to get it done. They can do it themselves. Prime actually increased. What we should see with this money coming out of the government money market funds is we should start to see less reliance on the reverse repo. Well, we'll see on the next screen. So a lot of stuff on this screen, just a big data dump screen. The next FOMC, July 26, is 31 days away. Canada's next meeting is 17 days away. on July, I believe July 12th or July 14th. June 14th, minutes will be out in 10 days. And May PCE we see in 5 days. For Canada, we get the CPI in 2 days. This is going to be important for Canada because I will show you shortly. PPI came out very deflationary. And the Canadian dollar has shown significant strength since the last Bank of Canada meeting. But there is a belief that given the structure of debt in Canada, that the Bank of Canada probably only has one more rate hike ahead of it. If this CPI comes in soft, the Canadian dollar will drop in value. I was over-hedged on the Canadian, and that worked out well. Now I've closed that hedge completely, so I have no hedge whatsoever. So I'm completely exposed to the US dollar, so any strengthening of the Canadian wouldn't be friendly to me. But I think that we're near the top on the Canadian. I think the Bank of Canada is near the top of its rate hiking cycle, if not done at this point. But the Tuesday, the CPI report will be important. Big risk event factor for the Canadian dollar. Sunday, Williams. Wednesday and Thursday, both with Powell, both live. If you look at the Federal Reserve site, if you Google Fed governor speeches calendar, all those words, you will get a calendar of events up, and the upcoming events that will be live will have a little icon beside it. You can click on it and watch it live. Wednesday, 9:30 a.m. Policy panel discussion, ECB forum on central banking, and Thursday, 2:30 in the morning on our continent, dialogue with the Bank of Spain governor. And then on Thursday, late in the day, Bostic is speaking. So you just have Williams and Bostic outside of what Powell is doing. Odds on for no hike on the next meeting, the July meeting, 28% up from 25, 72 on 25 basis points. The interesting stuff comes in December. The 475 is gone and a 6% shows up. Yeah, it's only got 1%, but it's still on the board with some weighting. The 5.75 is now at 13% from 5.9. 550 relatively unchanged, and the weighting that was on the 5 and the 525 has now moved up. So the market seems to slowly be moving towards the idea of 2 more rate hikes, 5.75, and even putting some weight on 6%. Effective federal funds rate 5.07, and on the previous screen I said we should see a drop in the reverse repo if money is the institutional money that's coming out of the government money market funds being able to buy its own treasuries is less reliance on money market funds using the reverse repo facility. Looky here, we're under that $2 trillion mark, a drop of 42 billion. Let's see if that holds. Maybe we bounce back up of the 2 trillion mark next week. But if that continues downwards, well then the Fed had it right that in the press conference when asked about the issuance of treasuries and what the Fed expects for that, he said that he expects most of the reverse repo to absorb all of that. And on the previous screen again, institutions pulled out 25 billion out of government funds, government money market funds, so they don't need that. So that probably came out of the reverse repo. Institutions can do it themselves. So the discussion last week about, oh, well, money's flowing the other way now. Well, no, it's not. Money is still flowing in to safe haven assets, to money market assets. It's just not using a money market fund as a vehicle to get it done. It's doing it itself. But money is not leaving the money market. It may be leaving money market funds to go directly, because investing in a money market is an indirect investment in money market assets. It may be leaving the vehicle of the mutual fund, but it is not leaving the money market. So that was sort of misleading reporting last week, saying money is flowing out of the money market. No, it's not. It's flowing out of a vehicle that allows for indirect investment in money market assets and flowing into a direct investment in money market assets. But on net last week, money entered the money market. It did not leave. It entered the money market. The Treasury General account last week was 250 billion. Now it's 366, so another increase here, 116 billion. And our lags and our effect. Pick the lag you like. If you subscribe to interest rates work with a lag, what lag do you like? I think it's somewhere around 10. We'll call it 10.5. So we're somewhere between 200 and 350 basis points of hikes that have yet to be felt in the wider economy. So the statement that interest rates work with long and variable lags. The academic literature has some stuff on that, but there's no agreement on exactly what the lag is. There's some rough standards with housing. It's about this much. In this sector, it's about that much. But again, no wide agreement. So pick your lag, and that's how much effect needs to be felt. There are some who say it's up to 2 years, and if it's up to 2 years, then a full 500 basis points need to be felt. I don't think it's 2 years. I think that would be a ridiculous statement. I think 10.5 seems to be about right. That we're somewhere between 200 and 350 that still need to work its way through, and 50 in the barrel. All right, real yields pretty much holding up. Not much movement here. 30 basis point inversion from the 5 to the 10. The 5 is at 183. The record was 192. So if you are thinking that there are more interest rate hikes ahead, but that inflation is going to be sticky where it is right now, think about that. If inflation is sticky where it is now, but we have more interest rate hikes ahead, that means the real component of that nominal yield will be going up. We may take out, I'm checking the wrong numbers here, we may take out the October highs on the real rates. Now, real rates are the bigger pain for future cash flows, for discounting future cash flows. So the higher real rates go, the more negative that is for valuations. More so than just a nominal yield rising, because nominal yields can rise because inflation is rising, and if inflation rises, well, that's everybody's selling price rising. It's the real rate that's more important. Look at the curve here for federal funds rate. Last week, bottoming out in October with an implied rate of 5.29. Now we're pushing all the way to November, where it's bottoming out at a rate of 5.32. And the December is sitting at 5.275, just above the upper end of the range right now. Still not pricing in 50 basis points, but it is flattening out. It's in the implied rate increased by 4 basis points, increased by 4.5 here, and extended out 1 month. If you go out to March, it increased by 2.5 basis points from 94.97, a drop to 94.945. So we've gone from 5.03 to 5.055. Slowly coming out, but we will see that this will eventually, over time, as long as the economy doesn't break, that curve will still flatten some more. Over 2024, drop of 144 basis points. Still expecting cuts in 2024. The December 2024 rate 3.79 from 3.8, basically unchanged. This went from 518 to 523. This is using 3 months SOFR. For TLT, rather surprised at the performance of TLT. It actually eked out a gain, 0.71 for the week. I wouldn't have thought so. S&P down 1.42. There's our negative correlation. Hopefully that'll continue to hold. Still implied volatility rather low, but it is creeping up on the 13-week to 5%, but the premiums just aren't there. I have made no changes to my positions on TLT. Okay, last week I said it would be the last week for a separate screen for the OAS. I'm just going to sneak it into the mortgage and housing screen. And again, nothing to see here. Little changes. The OAS just does not seem to be sending us any signal at all. So until it starts doing something, really there's nothing to see here. Mortgages down another 2 basis points, not much, 6.67. Over the same period of time, the Thursday over Thursday, the 10-year increased by 8 basis points. This decreased by 2, so the spread decreased by 7, but that didn't help the mortgage REITs. Agency down 1.78, annually down 2.28, ABR down 1.59. And last week we found out that ABR is going into the S&P 600. It had a nice bounce well into the $14 range before pulling back with the fear of higher rates. So I expect this to continue to perform well once it hits the index. All funds that have that as a benchmark will have to buy it to some degree unless they underweight it by having no weight on it whatsoever. They'll have to buy it and hold it to some degree. IYR, this is down 4.16. From year to date is down 2.49. I would have expected it to be down by more than 2.49. Continues to hang in there. Even with all of the issues with commercial real estate coming up, I really think that this has much more downside to it. Housing, we've been talking about the 7 stocks leading the market, but have a look at housing. In purple, I've got the year-to-date returns on housing. And now this is becoming troubling because I did see housing as something that I think has, many years left to run. But so much is being priced in so fast that it's hard not to just say, okay, well, look, I'm going to take my profits here. But every time I think about it, I say, well, let's just let it run a little bit longer. And every week, new 52-week highs. Well, this can't continue on. You start to get uncomfortable with these type of gains. DHI up another 3.43 for the week, 32.77 year to date. That's not from the lows. That's not from the October lows. It rallied from the October lows to the end of the year. This is just from January 1st, up 32%. Lennar added another 1.9, up 33%. Pulte up another 3.75, 65% year to date. 65%, that rivals the tech stocks. Toll Brothers 3.55, that is 50% year to date. KB Homes up 2.46, 60% year to date. Hovnanian pulled back 5.61, but even still is up 115% year to date. A home builder, look at these numbers, 50%, 60%, 65, 115. You would think I was talking about tech stocks here. I'm talking about home builders. Now, this kind of run, you start to get uncomfortable at these levels saying, well, I don't know if I want to enter at these levels. Because if something does fall off a cliff, if we do have a recession, these stocks will pull back. But any pullback on this is going to be a buying opportunity. But at this point, I'm uncomfortable selling puts on them because I don't want them put to me even at the put price. So I think I'm going to pull back on that. They've just run too much. I mean, come on, housing stocks, look at that. XHB up 5.1% for the week, up 25% year to date. This is the home builders. This is home construction, ITB. iShares up 1.85 for the week, up 34% for the year. Look at these numbers. And this is halfway. We're only halfway. That's not an annual return. Well, that's just 6 months. We're 6 months into the year, and look at some of these returns. This is what did it here. The data from last week, the housing market index at 55 in expansion territory, up from 50. It hit a low of 42. That's contraction. It's a diffusion index, right? So anything over 50 is growth. Anything under 50 is contraction. Went from 50 to 55 in expansion. Building permits up 5.2%. That's month over month. Housing starts up 21.7%. That is not year over year. That is month over month. That is May over April, up 21.7%. You got a housing sector in expansion. Building permits, 5.2%. Housing starts, 21.7%. These guys all jumped on that news. And even though the markets were printing red throughout the week, I was waiting for the home builders to give me some red so I could sell puts, and they didn't. It was green, green, green. And I thought, wow, look, we're pricing in so much right now that I'm, like I say, I'm uncomfortable continuing to sell puts at these levels. Mortgage apps eked another 0.5% gain. Refis were down, but purchases up. This week, what are we getting? Existing home sales for May. We got that last week. Existing home sales were up 0.2% month over month for May for existing home sales. This week, we're going to get the housing price index for April, which also comes with Case-Shiller. New home sales for May we'll get on Tuesday, and Thursday you get the pending home sales for May. Watch this housing price index, because if it is strong, there is the base effects that the Fed is hoping for in the housing component of PCE. There's their argument gone for base effects, right? They said, look, we expect goods deflation. It's just not happening at the speed we thought it would. We have housing, which with base effects should just disappear. And then services X housing is the sticky component. Well, the goods deflation not happening as fast as they want. If housing is not going to give them those base effects runoff, if the housing price index is up strong and not going to give them that runoff, that 50 is pretty much going to be a done deal, maybe even 75. So I think that'll be an important thing to look at. Okay, I'm combining two graphics on the screen here. I'll separate this one over here. This is from Moody's. I saw this on LinkedIn in the feed and saw that it was from Moody's. I thought, okay, well, that's a reliable enough source. I'll use this one. It is restricted to U.S. commercial real estate only, and here they're trying to make the case that the risks vary by property type. And I think the most at risk is retail and office. Multifamily is on here, and multifamily property values have dropped significantly in the U.S. The same in Canada, which is surprising because the growth in rents in Canada are significant. In Ontario alone, this is crazy. Rents are up year over year 30%. Just let that number sink in a bit. How is your property value declining when your net operating income is growing that much? Well, it's the interest rate, right? So let's just look at retail and logistics here. There is a trade-off going on here. There is a migration to online, and the pandemic, I think, accelerated that. For example, before the pandemic, I really didn't buy anything on Amazon. Not really. A book here or there, but never anything outside of a book, and usually just a digital book. But now I do. The pandemic has normalized me to saying, well, I need this. I'm not going to leave the house. I'm not going to go stand in line outside a store while they allow two people in the store to shop. I'm not going to do that. I'm just going to order from Amazon and be done with it. So it trained me to order from Amazon. Well, that's a habit formed. Well, a habit formed is a difficult habit broken. So I continue to order from Amazon. So I think this migration to online continues and even increases. So logistics centers or logistics REITs have been buying malls and turning them into logistics centers or distribution centers or even warehouse centers. So I think that continues on. If you look at any of the industrial REITs, so they own warehouses and logistics centers, and you look at their occupancy, they're almost at 100%. Almost all of them at 100%. There's simply just no room at the inn. And there may be this thinking that, well, we're transitioning from a goods-based economy to a service-based economy, that we're more interested in purchasing experiences than we are in purchasing stuff. That's going to hurt retail more than it's going to hurt logistics. Because you can get rid of 1 million square feet of retail and replace it with 250,000 square feet of distribution center. So retail is going to be the one that gets hurt the most. But logistics, they're fully booked. They don't have, you have to keep buying new facilities to add more. So I don't see too much of a risk to logistics, but retail I wouldn't touch. Same with office, I just would not touch. Have a look at this down here. Office availability rates in selected U.S. downtowns. These are all gateway cities. And if you have buildings in these cities, they're more than likely going to be Class A buildings. Look at this, 32.7 in San Francisco. Houston, 32.5%. Los Angeles, almost 30%. Chicago, 26%. Seattle, I mean, we're starting to get into these cities that have adopted a lot of liberal policies, and crime is just increasing. So this could be a function of crime, like San Francisco, Chicago, LA, Seattle, right? Look at Boston, 17.4%. Manhattan, 19.5%. Philadelphia, 21.7%. These are big numbers. So you own a building with a 17% vacancy, and you have a lease coming due. You're going to go to them and say, okay, well, we need to raise your rents? Where's your power to raise rents when throughout the city you have that kind of vacancy rate? Now, I'm certainly, if I were a tenant and I was renewing, I'd be negotiating that rent down hard, because I have options. I don't need you. I have options, and you're 20% empty. So you want to keep me? I need a lower rate. So if you think about the cap rate, R minus G, we have seen that we have rising R. And, you got another 50 basis points in the chamber that the Fed says it's loaded bullets for. You have no G. Where are you going to get growth in rents from? There is no G. If anything, you'll be lucky to renew at the same rates. I think your G will be even negative, which means you've got a cap rate higher than a discount rate. You got a lot more downward pressure on prices for offices, especially in secondary cities, and especially for Class B properties. I would almost write those things off. So I don't think for the office space, I don't think we're anywhere near done. $736 billion in there. And we're seeing defaults happening already. 550 million here, 770 million there. That's not even $1 billion. So multiply that out to see how much more is going to happen. For the office REITs, here's the most likely outcome is when they have to roll over their debt. They may have a bank that is willing to do it, or a private lender that is willing to do it with a larger equity stake, which means higher debt costs and share issuance. So there'll be dilution. If they can roll over their debt, you're guaranteed to get shareholder dilution. Almost guaranteed to get share, because you're going to have to come up with, if you have lower property values and you're trying to roll over the same amount of debt, you're going to have to raise your equity considerably. And if you have depressed prices, you're going to have to issue a hell of a lot more shares to get that done. So for the office REITs, what you have ahead of you are lower valuations, higher financing costs, and share dilution. You're going to get dividend cuts. There is nothing pleasant in the office space at all. Nothing pleasant. At some point, the ugliness will be over, the worst will be over, and they'll be either written off or at an extremely low value. There's where you buy them, but certainly not now. Retail, same thing. I wouldn't touch retail. Multifamily, yeah. Logistics, yeah. Hospitality, I would stay away from that, because in a recession, those things suffer badly. They go straight down. Mortgage Bankers Association says there's 1.4 trillion in commercial real estate debt in the banking system due through the end of 2024. That's the Bankers Association. So that's not counting publicly traded debt from REITs. This is just what's on the banking book. 1.4, because these are just the numbers outstanding in the U.S. What is due by the end of 2024 is 1.4 trillion. That's a lot that has to be renegotiated, and a lot of share issuance that has to come in if the property value is valued lower and you don't have the equity buffer. Yeah, you got a lot coming in. This line here, likely risks as the cycle turns. Rent growth slows to single digits, perhaps in the U.S. I can't see it in Canada, simply because the level of household formation in Canada is so much higher, just because of the aggressive immigration policies that the government is following right now. And we have a housing shortage, just like the U.S. has. So combine a housing shortage with a very high level of household formation. They got to go somewhere. So I can't see rent slowing to single digits unless they just say, listen, we need to get rents down. We got to stop immigration for a while. and let housing catch up. That's not going to happen. That's not going to happen. Our level of immigration is not going to slow down with the same probability that the rate of immigration in the U.S. is not going to speed up. That's just the way it's just the way it's structured right now. Logistics, tenant bankruptcies rise. Even if you get rid of one tenant, there's a waiting list right now. You'll get another one in. I'm not too concerned about that. Retail consumer spending slows. Tenant bankruptcies rise. I think you'll see more of that. Tenant bankruptcies rise. Consumer spending, I think, will shift more and more to online if you can find better deals online and through Amazon. I'm finding, when I look at things in stores and I look at Amazon, I have Prime, so with the shipping, with the free shipping that I get, it's worth it. You save significantly by getting it from Amazon. So I think that continues on. And again, it's the pandemic that trained me to do that. Office, work from home, further cutting demand. I don't agree with the work from home, but it is what it is, right? So the two big shifts going on in society is the way we buy things and how we buy things, and how we work. So retail and office, I think, are in a lot of trouble, but multifamily logistics, I'm happy there. Let's have a look at the site for Green Street. All right, I have shown this site before. I'm on the North American. You can click over on this button and flip it over to Europe if you want. This is the Commercial Property Price Index, and it gives you a chart. You can click Download CPPI Report, and you get this report up, and it breaks it down into a little bit more detail for you. I find this interesting. If you look at the sectors here, sector level indexes, all property, the index value 131.4, past month, past 12 months, and from the recent peak down 15%. This one here, apartment, down 21%. I think that just represents a buying opportunity, really. Office down 27. It's going to be down 50. That's got a lot more to go. Strip retail, I think, will hurt more than mall retail. Where is mall? Down 18. Strip is down 14. I think that's got more space to go as well. Self-storage down only 11%. Lodging down 3%. Wait till you get a recession. That'll be down even more. This is cumulative change for the past 7 years. Look at the best performing ones here. Industrial and manufactured homes. Then you have self-storage at the very bottom, malls, and then offices. Malls have been in decline for a long time. Since like the mid-'80s, there was way too much mall space in the U.S. That's been shrinking every year. It's still got more to go. I mean, I go through the mall here in St. Catharines. If you look at the directory when you first walk in to see what stores there are, you look under clothing, you got 27 clothing stores. With 18 of them pretty much all the same. You look at all of them, you go, but this is the same stuff as the last one. Do you really need that many different stores? And I think it's crowded. I think a lot of those are going to disappear. Offices, look at this drop here in office. I think that continues for quite some time. And strip retail, basically flat. Apartments, this to me doesn't make any sense considering the housing shortage that exists. That apartments would be having trouble, and I think the trouble from apartments is really just coming from the increase in the discount rate. So I do see that as a buying opportunity there, but industrial, I think, continues its strength. Anyways, that's there for you if you want it. Link is in the description box below. During the last week, PPI came out for Canada. This is for May, negative 1%. The forecast was for negative 0.7, and the previous month was revised down even lower to negative 0.6. Year over year, down 6.3%. Raw materials prices month over month down 4.9%. Year over year, the forecast was for negative 12.8, negative 18.4. And on Tuesday, we have CPI for May. The expectation for core year over year is 3.9. The last read was 4.1, so we're expecting core year over year to drop, and headline to drop to 3.4 from 4.4 last month. We get that Tuesday. Next Bank of Canada meeting is July 12th. The probability of 25 basis points is at 75%. So the probability of a hike is still in there. This is a headline from Bloomberg here. Bank of Canada now expected to cap rate hiking campaign at 5%, which means one more rate hike. Forecast for real GDP growth for Canada is less than 0 for Q3 and Q4. In other words, there is a forecast. The consensus forecast is a technical recession for Canada in Q3 and Q4. Canada has much higher household debt than the U.S. Not only that, Canadians are far more sensitive to interest rate hikes because of the nature of the mortgage market. In the U.S., you can get a 30-year fixed rate mortgage. So anyone who got their mortgage before April of 2022, before the rate hikes start, they're insensitive. Their mortgage payments are insensitive to changes in rates. In Canada, you can get a 5-year mortgage based on a 25-year amortization. So every 5 years, you got to go back to the bank and sing for your supper. You have to continually renew your mortgages. And Canada has a higher proportion, I think it's like 22% versus 10% in the US, a higher proportion of floating rate mortgages. So Canadian households are far more sensitive to interest rate hikes than US households. So they will feel it faster and probably lead to a consumer slowdown sooner than it would happen in the US. For May, the jobs report that we got in June for May showed a contraction of 17,000 jobs in the U.S. Unemployment ticked up 0.2 to 5.2. This is the first rise in unemployment in 9 months, the first increase in unemployment in 9 months. The U.S. CAD pair hit $1.32. This is the U.S. getting stronger. This is the CAD getting stronger against the U.S. when it's moving down. 132, 9-month low on the pair. Said another way, the Canadian is at a 9-month high against the U.S. So I am now overweighting the U.S. dollar, and I will continue to add to that. That means I'm going to short the Canadian dollar, and shorting means I'm buying this pair. I'm buying the pair because it is the U.S. When you see a quote given this way, US.CAD, it's the first pair that you're buying or selling. So I'm buying the U.S. against the Canadian because I think the U.S. is going to strengthen. And if the U.S. strengthens, then this moves upwards. That means the U.S. buys $1.33, then it buys $1.34, then it buys $1.35 Canadian, etc. So the higher that number, the more of the Canadian dollar one U.S. dollar buys. So I am going to be shorting the Canadian by buying the U.S. CAD pair. The CAD yen pair sitting at 109. I sold 215,000 at 109.07. So I'm selling the pair. When I am selling the pair, what I'm expecting is the Canadian to weaken against the yen. I do expect the Canadian to weaken, and the yen is getting to the point of the Bank of Japan trigger point. That means that it weakens to a point where they say we don't like this, and they've intervened twice now. When it was in the high one against the U.S. dollar, when it was like 148, 149, 150, they intervened. Not only that, their inflation rate is well above their target now. So there is thinking that they're going to have to abandon yield curve control or face a lot of capital flight out of their own country. They're going to have to abandon it. And if that happens, then the currency will rise. And if the currency rises, that's going to start at the margin to unwind carry trades because you have currency risk in carry trades. So money is going to have to repatriate to the yen very quickly to pay off the borrowing because if they're funding in yen and the yen exchange rate rises, you start losing on that carry trade. So they're getting close to that point. I think the Canadian dollar is topping out, and I think the yen is bottoming out. So I think that those two paired together can make a big return. Much better than the Canada against the U.S. and the yen against the U.S. Why not take out the common currency, which is the U.S., and trade the CAD against the yen directly? So just to be clear, why I'm doing this is I think this is a true statement. I think the Bank of Canada is near the end of its hiking cycle. I think it recognizes that Canadian households are far more sensitive to the interest rate than it is in the U.S. And yes, there are lags, and most of the rate hikes have not found their way through the system yet. That there is a far greater risk of breaking things in Canada with higher rates than there is in the U.S. So I think the Canadian dollar has had its run. I think it's topping out right now. Doesn't mean it's going to retreat tomorrow, but I think it's toppy around these levels. And I think the yen is getting to the point where the Bank of Japan says, okay, well, we don't like this because we have to import our energy costs. And a lower yen is just adding to inflation by importing our energy costs. And we already have inflation above target. And we're still following a very accommodative monetary policy. So we have a stock market that's on fire. We have inflation that's above our target. We have an economy that seems to be doing well. What are we doing? What's going on? We're going to get capital flight soon. So I think that we're at these turning points on these two. So that's why I'm playing the CAD yen on this one and watching Tuesday very carefully that CPI. If it comes in hot, well, then it's not going to work out too well for me. But these are initial positions I put on. I'll still continue to add to it, but it would not confirm one more rate hike. It might start pricing in two more rate hikes like the Fed is doing and strengthen the Canadian dollar. But if it comes in soft, if PPI has any indication here and this comes in soft, then yeah. This would have been the right trade at the right time. Okay, this is copper. This is a 2-year chart of copper. Here's April 22, and of course the rate hike cycle began. It hits interest rate sensitive sectors first: housing, heavy equipment, things like that use a lot of copper, automobiles. So down it went. I find this rest of the chart rather interesting. Look at this rally that you had over here. This can be traced to the first China hope. The party conference was over. Xi is now dictator for life. And there was a belief that China will be dropping its COVID restrictions. So up it went, and it didn't drop its COVID restrictions. So it pulled back, and you had this going on here. You have protests over the lockdowns. Second China hope, well, okay, let's get rid of the lockdowns, and copper rallied, but didn't hold on to it for very much. And then you had the third China hope, oh, there's stimulus coming in, that's going to be great. Well, not so much at the very end. We're seeing that that's still not really helping out in China very much. So there is some near-term, I think, difficulties for copper to break much above $4 a pound at this point. And as rates push higher, it's going to become even more difficult, I think. Something somewhere is going to break. So I think copper is a bit under pressure. But long term, if we're going to have this energy transition and move to electric vehicles, which I can't see that slowing down at this point, you're going to need a lot more copper than the capacity in mining that exists today, period. So there is going to be some capacity constraint somewhere on the horizon that it'll keep copper elevated. And I think, never mind about $4.50 or $5 copper. In about 4 or 5 years, you got to be thinking about $8 or $9 copper, like double the price from where it is right now. So copper and copper miners for me are a long-term play. On HG here, if I look at the bottom over here, it's roughly about 360. So any push to the low 360s on copper, I'm going to sell the December 335s, which would put me somewhere down here at the lows of this level. So if we push down to the recent low, if the price retraces here, I will sell puts with a strike price at the previous low at 335 with a March underlying. Right now, the current premium is 8.75 cents. I think if we get to the low 360s, that premium with some volatility might get to 13 or 14 cents, but right now it's 8 0.75 cents. May not sound like a lot, but the contract's for 25,000 pounds. So if I sold a December 335 put, given where copper is right now, its premium is 2,187.50. Margin is 10,270, which is roughly 21% over. And since this is the Decembers with the March underlying, they expire in December. It's 6 months, 6 months time, 21%. And that is if I do it now. If I wait until it hits the low 360s, if we get to the low 360s, I will get more than 875. I'll get 12 or 13, maybe even 14 cents with some volatility. So I'm playing copper directly and the miners. The miners, COPX, are a great place to be, and Freeport, FCX, is in terms of the amount of copper put out, Freeport is the larger one. You can use CPER, which is an ETF for copper, which holds futures contracts and treasuries. So they de-lever the futures contract. Reason they're holding the treasuries is so they can get no cost of carry. Because if the futures have a cost to carry and you're holding treasuries which have carry, you negate the two. There is very little cost of carry in these, so the CPER is probably getting a nice return. Even if copper goes sideways, it's going to get a nice return off the treasuries. Not great, but a return. I looked at selling puts dollar for dollar, in other words, the same notional amount, whether I'm using the ETF or whether I'm using HG. If you sell puts on copper, it is the premium you're going to get is comparable on the same notional amount. However, the margin over here is 3 times greater than the margin you would need here. This is just far more efficient. But if you are not adept at selling options on futures, but you want long-term copper exposure without having to worrying about rolling over your contracts all the time, CPER can do that for you. If you're more interested in the copper miners, COPX can get that done for you. Okay, here's a 5-year chart of wheat. And it was a more interesting story Saturday morning when I started this chart. Not so interesting now. What was interesting was that the head of Wagner Group in Russia was headed towards Moscow. 125 miles away from Moscow, ready to overthrow the government, it seemed. And if that was the case, then wheat, what was going to happen there? Was that going to open up a lot of Russian wheat to the market? That wheat's already finding its way onto the market anyways, but would it have improved the Ukrainian wheat's access to markets as well? Because he did say that Russia's war against Ukraine was based on lies, that they weren't rearming and there was no Nazification of Ukraine. Well, this guy's now gone. I guess that whole thing ended badly for him, and he's in Belarus. At some point he'll be assassinated because, well, he made Putin look like a fool. At some point he's going to be assassinated. This thing is over, so I don't know what the effect is going to be. But the pricing action on Friday wasn't very friendly to corn, to soy, or to wheat because it had some significant run-ups. Let's have a look at corn. On Friday alone, down 6%. If you look at the price from May 16th to June 20th, it had gone from $4.99 to $6.28 in that period of time. In a 30-day period, it had gone from $4.99 to $6.28. Closed at $5.87 on Friday. That's the down 6%, $5.87, but after taking off from $4.99. So if it continues to pull back, I will sell puts such that I have a $5 break even. So if I see it pushed through to like $5.40, I may sell if the 580 puts allow me to have a $5 break even. That's what I'll be looking for in the money puts, already in the money, that engineers a $5 break even on any significant pullback here. Soy, same thing on Friday, pullback 265. This is it had an even wilder ride here. May 30th to June 20th, just over a 3-week period, went from 11.46 a bushel to 13.77. You should know that when you see these quoted, you'll see wheat quoted as 13.77. It is quoted in pennies. That is 13.77 per bushel. Same with corn. When you see it quoted at 628, that's $6.28. It's 628 cents. So the grains are quoted in cents. 11.46 to 13.77, pull back to 13.04. And if it continues to pull back, I will sell in the money puts such that I can engineer an 11.50 break even. I'd like to get 60, 70, 80 points in the money and get the 11.50 break even. But I got to wait for the market to give me that. Wheat, look at the run up it's had here from 6s to 7.43. Wheat held up a little bit better on Friday than the other grains. And here again, on any pullback, I'd sell puts with a $6 break even. If I can engineer a $6 break even, I would do it. I'd go in even more. I think that over the next 10 years, given climate change, that the floor price of these will slowly increase every single year. So looking at a $5 floor for corn, I think is about right. Looking for an 11.50 floor on soy, I think is right. I don't think it's going back to $9 or $8.50. And looking at a $6 floor on wheat, I think is probably right. The biggest threat to wheat is peace breaking out in Russia and Ukraine, and that wheat being able to hit the market unconstrained. That we don't know how much would hit the market, but just the psychology of it would push that price down. Okay, let's have a look at SPY. The forward 4-quarter operating earnings from S&P Global, 222.14, down 0.43 week over week. SPX closed at 43.48, which gives us a 19.57 times forward earnings. The as reported figure is 204.50. This is just operating earnings. This is as reported, so it's bottom line. Still, really no implied volatility here at all. There doesn't seem to be anybody who cares to buy puts. The year-to-date gains have all been multiple expansion, and about 80% of all the gains are down to 7 stocks. A little while ago, it was 100% of all the gains. About 80% of the gains because there has been more stocks rallying in response to the equity rally. And I've explained that before. It's not that everyone's jumping on board. Some people are, but other people are saying, well, listen, I got to buy something. But I can't buy those 7. I'm sorry, I just can't get on board this. The valuations are ridiculous. So they're buying, more beaten up sectors, which is, giving a lift to the market, a more wider lift to the market. So we've had a pullback over the last week by about 100 points. We're learning that, there are 2 more rate hikes ahead. Suddenly, the conversation started shifting towards valuation. I think we've run too far too fast. The valuation of some of these stocks just can't be justified. That started creeping into the conversation. And the economy. Leading indicators dropped again. So well over a year now, you've had this drop in leading indicators. Whenever you've had this much of a drop for this period of time, it has always led to a recession. So you have 2 yield curves signaling that this has always led to a recession. You have leading indicators now, not concurrent, but leading indicators in an area where it's always led to a recession. To not have it would be odd. The conclusion that you would reach is that we must have had a regime change, that the economy is fundamentally different now than it was in the past, such that these indicators no longer mean what they used to mean. And if that's the case, then we are in an uncharted territory, because if these indicators no longer mean what they used to mean, I have no signposts. I'm trading blind. The other thing that we noticed last week too, it seems to be that more and more voices are getting tired of the AI story, that it had its hype, and as you sit back and think about it, you go, oh, hang on a second now, is it really true that every company is doing AI? Because right now every company is saying AI as many times as they possibly can in their conference call, whether it's predictive AI or generative AI, everyone's jumping in on it. It seems to be exhausting itself out that, some companies are saying it and it's followed by the eye roll of, oh, come on now. What are you doing with AI? Everyone's jumping on board. Implied volatility loss, 10.9. There just is nothing there in the premiums at all. So what am I doing? You'll recall when the June, last Friday, the June futures expired, I did not roll them over. I just let them expire and kept my September positions open. So I do still have a short position, a net short position, but it's much lower than what it used to be. And I have more long positions now. So 44.50 on the index itself. I'm going to sell the September 44 calls with the December underlying, and I'm going to sell them heavy. I cannot see the upside. The more I think this through, the more I think that you got more interest rate hikes ahead of you. You are going to every quarter have at the margin 1 or 2 or 3 companies whose previous swaps have rolled off, and they have to enter into new swaps at a higher fixed rate, that you're going to have that creep in. If you are going to, when I think about the scenarios, the economy is going to be fine, then it's higher for longer. That neutral rate's got to be higher. You've got to raise the discount rate. This is not the environment for multiple expansion. I can't get past it. What made me not roll my June contracts over is just the sheer performance of the equity market, in absolute disbelief of everything that I've been looking at, thinking, what is everyone seeing that I'm missing? Because I feel like I'm all alone over here. So I just let them run off, because I thought, okay, well, we've left a valuation-based market and we're into a momentum and psychologically induced market, all based on AI hype. You can't stand in front of that stuff. But last week it felt like it was slipping away, and I thought, well, that just figures, right? I mean, I let my futures roll off on a Friday, and Tuesday morning after the long weekend, we come in and everyone's sour and dour, and oh, maybe Meldrum was right. Now that his position is lower, let's really let's really do this. I was holding the market up all that time with my big short position. I'm sorry for that, folks. Anyways, I will get aggressive again. If I see this thing try to peak up in any way whatsoever, I'm going to get aggressive. Rates are going up, not down. The money supply is going down, not up. Unemployment's at a 50-year low. It's not as if we can add 2% more to employment and have all of this extra retail spending. We're already there. And energy and materials are trading down, anticipating a recession. I think the bond market's got it right. The commodity market tends to respond fairly well to these type of signals. The equity market just doesn't want to come along for the ride at all. It's just defying everything. Hard to short, but it's hard to buy. So I am buying certain things. I'm buying the miners. Copper, this is giving me a good chance to get into those. FCX and COPX, that is an ETF for the miners. I already explained the CPER. Canadian apartment REITs. I'm more than happy to buy Canadian apartment REITs. I still have my wheat trade in place. I still think that's a fairly good trade. I still have my spread trade in place between cattle and hogs. And when corn prices rise, it actually is beneficial for that trade. When corn prices fall, it actually hurts that trade a little bit, because cattle are corn fed. And the higher corn prices go, the more expensive it becomes to feed those cattle. So I still have that in place, and I'm adding the Canadian yen trade, and I am shorting the Canadian dollar. at this point, and on any rally, any substantial rally in the index. If I see it move up, all I need is a 50-point move up. Then I will start selling those September 4,400 calls with the December underlying, because they'll put my break even somewhere around 4,600. We're 43.48 on the SPX. Are we going to, after running as much as we have, do we have another 250 points in us by mid-September? I don't know. Now we do have PCE at the end of the week. That may give us support. I mean, everybody cheered the CPI last time by ignoring core and just focusing on headline and saying, yay, let's ignore the important part. Let's pay attention to headline. Will they do the same thing for PCE? Even if the important stuff comes in sticky or bad, if the headline comes in great, will the market just say, hey, let's just pick and choose what we celebrate, and we'll celebrate just the good stuff? Does the AI story come back this week? I read one article from Barron's this weekend that AI stocks are far from being in a bubble. You have to shake your head saying, hang on. It's not that they're near a bubble. It's they're so far from being in a bubble. You must be kidding me. You must be kidding me. Anyways, there it is. So does that grab a hold? Do people start saying, yeah, we haven't even begun to price in the hype yet? I don't know. But I am more convinced every time I keep looking at this market, every time I keep looking at the underlyings. If you look at the difference between in earnings and cash flows, you're getting drops in operating cash flows while you're getting increases in operating earnings. The quality of the earnings are disappearing. You're getting tech companies that are making their earnings by increasing the useful life of their servers, but I thought that AI was going to rapidly change the kind of servers you need. Well, what's going on there? So, none of this makes any sense to me, and I think it's a lot of earnings management going on to make these numbers, and I think, that some companies may just be right at the edge of what they can squeeze out of accounting principles, that unless the economy shows up, it's not going to happen. And what is showing up is higher interest rates. It's to not have any effect at all, to just sail through this and to report record earnings in 23 and earnings so much greater than when money was free and the government was handing checks out to people, to me is a big freaking head scratcher. Something doesn't add up here. And I'm just going to bet with rationality and logic that this stuff has been engineered, that a lot of these earnings have probably been engineered for as much as they possibly can be engineered. And the next leg of earnings gains has to come from major cost cutting, which means headcount. And if you lay off somebody, you take that much aggregate demand out of the economy. And that aggregate demand is somebody else's revenue. Do you get that? That's how recessions work, is unemployment starts to rise and demand starts to drop, which causes more companies to cut, which causes demand to drop more, which causes another round of layoffs. That's how it happens. How we can just sail right through it, just to me seems contrary to every little bit of experience I've ever gotten in this market. So, yes, short story. The short story is I will, on any strength, this market pops its head up, I will take a shot at it. Let's have a look at our calendar, our economic calendar for next week, and we're done. Okay, so Sunday, there's Williams. Not much happening on Monday. On Tuesday, there's your Canadian dollar risk. You have inflation in Canada and durable goods in the U.S. at the same time. Your housing price index at 9 o'clock. There's your Case-Shiller as well. 10 o'clock conference board, consumer confidence, along with new home sales. And then you get a bunch of these regionals in here, the Richmond Fed and the Dallas Fed. Sometimes they're ignored. Other times they can move markets, especially if they come in much lower than expectation. So Tuesday is a very busy day. Thursday, there is Powell at 9:30. I don't know if we're going to get any extra incremental information other than what we saw last week. He was on Capitol Hill for 2 days. I think we pretty much got the story. I don't know that he can do much more there other than probably repeat what he said. I don't know that we're going to get anything incrementally more hawkish than where we are. Bank stress test at 4:30. That'll be interesting. There's Powell again, 2:30 a.m. It's just a sort of a dialogue with another central bank governor. Don't know how interesting that'll be. Last look at Q1 GDP at 8:30. I don't expect this to change much. Pending home sales there. Going into Friday, there's your big risk. Is the core PCE and the personal income, personal spending indexes. And then at 10 o'clock, you have Michigan consumer sentiment. And that's it on the economic calendar. Earnings really don't begin for about another 2 weeks. By about somewhere around the 10th, 11th of July, we'll start to get earnings coming in.